So, good morning, Jonathan.
Good morning. Thank you for having me.
Well, very pleased to listen to the story. So we've got some slides that we can rattle through. So as normal, do you want to sort of start off by explaining a bit about what the fund is and what it's trying to do, please?
Yeah, no problem at all. So Pent, or Triple Point Energy Transition PLC, IPO'd back in October 2020 now, and IPO'd looking to deliver up to 8% NAV return to investors and pay a 5.5 pence dividend, rising progressively over time. Really what it's focusing on is investing across the whole of the energy transition, not just a kind of single technology or certain part of it, to deliver a broad, diversified range of opportunities to investors. And I think what this slide just hopefully tries to distill on a single slide is just some of the points of difference. We know it's a crowded market space in the energy transition. What are we doing that's a bit different? And yeah, to your point, trying to give you a sense of the nature of the company and I guess some of the key highlights. So taking that first point on the top of the slide, what we do, what the core of Tent is trying to do is to look across the whole of the energy transition sector, to look for the areas of mispriced risk, to look for those areas where we can get a more attractive risk-adjusted return. And we really focus on niche areas of the energy transition, niche technologies, to be able to do that. So if you look on the right-hand side, and we'll come on to it in a bit more detail later, but the technologies you see in our portfolio are combined heat and power, gas engines. You see hydroelectric power, LED lighting. There is solar, but only at development stage. And so I guess the point I would make is what you're not seeing is large scale operational solar, offshore wind or onshore wind. Those are, interesting areas of the energy transition, but ones that we feel have been subject to quite a lot of yield compression, high valuations, as lots of money is poured into those areas. And we think there's more interesting returns in those niches that we've looked at and that we've got in our pipeline, which I'll talk about later. The other thing that's a bit different about us is, as well as investing across the whole of the energy transition, we also invest in both debt and equity structures. Probably that's best explained why we do that through an example. So I think at the moment you might expect a solar project to maybe, if you bought the equity in that project and the project IRR to maybe be 6, maybe 7% on a good day. If you were lending, however, to a sort of a slightly more complex technology, perhaps energy from waste or bioenergy, you might be able to get teens returns just through lending into the debt piece. And so I guess our view was targeting high single-digit returns. We could put together a diverse portfolio of these things, investing in both debt and equity. So we really search out the interesting part of the capital structure and put together a portfolio of assets, which is diverse by technology and diverse by how we lend or invest in it through debt and equity. The second thing that naturally means if you invest across the whole of the energy transition is it brings a natural diversification to the holdings that the trust has. So we've got 5 different technologies, as I mentioned. We've got 19 individual assets, so well broken down by assets, no overexposure to a single asset there, and 9 different offtake counterparties to which we sell heat, we sell equipment, we sell electricity, so a diverse range of products as well. And our portfolio is at the operational stage, development stage, and construction. So again, what you're seeing there across the stage of development or revenue or technology base is a high level of diversification. I guess the third point, which we think is quite unique in the market, is the really high levels of contracted income for the trust. So in FY23, we announced our results on Monday. 100% of our income was underpinned by contract, and 46% of that income was contractually linked to RPI through subsidy payments on our hydro portfolio primarily. But I think the really interesting piece for investors maybe looking ahead is over the next 10 years, in fact, indeed over the next 14 years, 92% of the forecast income is underpinned by contract. And we think that gives a really nice risk-adjusted return, a really stable underpinning for earnings to our shareholders. And those earnings, as we reported on Monday, we think have been really encouraging in the portfolio to date. So our dividend cover on a cash basis was 1.1 times. Actually, if you strip out the effect of an exceptional item from back in November, it was 1.2 times. And our NAV returns are ahead of target. We delivered a 9.2% NAV return. And as we've said on the right-hand side of the page, based on the share price as of the 31st of March, that's an implied yield of 9, which even in this high base rate environment, we think is quite interesting. I think the final point on here is around that we've still got a lot more, I guess, earnings to come on stream. So when we look at our portfolio, you'll see that we've got about £40 million worth of battery energy storage assets to build out. And obviously, as you build those out, you deliver earnings from those, and that you'd expect would further drive the dividend cover figures that I've presented here. So there's, even if we, in a difficult environment in the markets, we've still got ability to drive profits and drive earnings to shareholders from our resources already. And finally, the last point on there is our pipeline. We think this is really important. There's a lot of I guess people thinking about whether this is still an attractive asset class to invest in this world of higher base rates, and obviously 50 basis points increase the other day. We think it absolutely is, but you've got to be able to find those niche areas. And for us, those at the moment are things like electric vehicle charging or charging infrastructure, electrification of the fleet, green hydrogen production, for example. And those returns tend to offer slightly more interesting returns at the high single, even double-digit return level. And so that would suggest that as the trust scales, we will be able to drive the weighted average return up and deliver higher returns to shareholders. I think the danger with being a single technology investment trust is obviously your return will always be linked to a return on that single technology in a single place typically. And so we think that broad focus across the transition enables us to look for those interesting returns as well going forwards. On the next slide, we've tried to do what probably many smarter people than us have tried to do, which is to summarize the entirety of the energy transition onto a single slide. There's therefore some obviously some serious generalizations here, but broadly we think about our addressable market in these three buckets. So starting on the left with generation, clearly the way to get to net zero is a net zero power system, and so renewable generation is clearly a really important part of that. Now we've invested in hydroelectric power. We think the returns there are slightly more interesting than solar and wind. But this is clearly a huge part of the energy transition, and without it, you're not going to get there. The second part of the energy transition, if you almost follow the electrons as they flow from the point of generation through the transmission and distribution cables and into storage, is battery energy storage is also a really important part of the system now. You've obviously got the fact that I think last year, there was enough energy from wasted from wind curtailment, so switching off wind turbines alone to power over 1 million homes. And over £1 billion of balancing costs was faced by consumers. So that's not great for getting to net zero, wasting all that energy. It's not great for affordability of energy bills. And so battery energy storage, we think, is super important to getting there. The third component of your net zero power system, of the transition to net zero, is actually what happens on site. So as electrons then flow from generation, they flow through the distribution and transmission, they've maybe been stored and then released at the point of demand. We get to net zero in terms of tackling things on site by doing either reducing the level of demand at a building, for example, or in industry. That could be through installing LED lights, for example, to reduce consumption, or through generating that requirement on site. And that could be combined heat and power or rooftop solar. So, but there's broader opportunities, as I mentioned, in electric vehicle charging, EV fleet, and green hydrogen, as well as heat networks, which are an increasingly important part of the way we need to decarbonize our heat, and of course, pumps. So a really interesting range of technologies, and typically actually that's where the most interesting risk-adjusted returns are. There's less competition, frankly, in terms of capital flowing in there, and there's much more interesting business models and innovation in that space. So turning on the next slide, you'll see our portfolio and how it maps to each of those three segments that I've just spoken about. So that starting again with generation, as per the previous slide, we've got our hydro portfolio that I mentioned, and we own the equity in that in a portfolio of 9 run-of-river assets spread across the Highlands of Scotland. We really like hydro, I guess, because, as I mentioned, slightly higher returns than solar and wind. We've got feed-in tariff subsidy here, so north of 90% of the price is kind of contracted and driven by that subsidy until 2035. So again, really high levels of contracted income. And that level of subsidy increases with RPI each year. So I think last year it went up by 13%. So really strong contractual, government-backed offtake for inflation. It's quite important at the current time, I would suggest. The other thing we've done in that generation space is invest in development. We're allowed to deploy no more than 5% of the fund in development, which has a slightly higher risk profile. But we thought the really interesting opportunity here was actually lending to developers. I know a lot of other players in the market sort of start developing, for example, a solar farm, and then they hold that for the operational period. We think that development of renewable assets in its own right is a really interesting opportunity. We've got I think over 50 gigawatts, well over 50 gigawatts of assets trying to be built onshore, let alone offshore at the moment. And there needs to be funding for them. And increasingly, there isn't sufficient funding given the long grid lead times and also the fact that planning is taking longer. So we funded one of the most established developers in the UK, a company called Innova Renewables, and that is a loan secured against their pipeline of projects. So we think that's a really interesting avenue of further opportunity for us and a really interesting, important part of the energy transition. In that second segment, energy storage, we've decided to lend to battery energy storage, and I'd be delighted to talk about why we decided to lend rather than do equity. I think there's a really interesting debate to be had there around the long-term revenue case in battery storage in the UK. We felt that debt was a more prudent way to invest in this asset class, and we've committed 45.6 million, of which 6.2 is deployed. And I mentioned earlier that the remainder of that we expect to be deployed over the next financial year, providing incremental earnings to the fund. And finally, on the on-site piece, we've invested in 3 CHP ESCOs or energy service companies, and we've got 25.1 million outstanding to them, and also LED lighting with an investment grade off-taker. So again, real diversification by the different structures, receivables, financing, senior debt, equity, by technology, by the different segments of the market. And so again, and also a mix, as I mentioned, by debt and equity, as you can see in the pie charts there. On the next slide, we've just tried to give a little bit more granularity to people around exactly what is deployed. There's a bit more still to come, clearly, in the battery storage that I mentioned. And in the post-balance sheet period, we've deployed 9.9 million. So the total, gross asset value of the company is 132.1 when you factor in commitments and deployments. And I think what the right-hand side of this slide is trying to show is the real diversification by segment, by technology, but again, by asset. And you can see that there's no one single asset is particularly large. We've not overly focused on that, and we think that's really important in the energy transition at the moment, particularly with REMA and other consultations on changing pricing coming down the track. On the next slide, we wanted to give a little bit more granularity around our revenues as much as we were able to, and to show you, because we think probably one of the key selling points of this company, we think, is their contracted revenues, and we've got their 92% over the long term. I would suggest that that's really important at the moment, given that we are seeing power price expectations cool off. We are seeing inflation expectations cool off, albeit not as quickly as probably the Bank of England would like. And so in that environment, that level of contracted income, especially when it's dividend covered, of course, is really important, and I think a real differentiator, and we think makes us a lower risk profile than many other investment trusts and some of our peers to have that for such a long period of time. And you've also got that inflation protection I spoke about there as well. Again, that comes through the government subsidy, and again, that goes well over a decade. We've tried to give a bit more detail at the bottom there around how that breaks down by assets. So we're really proud of how we construct and have thought about the revenue streams that underpin our earnings to shareholders, and how we make sure they're really well downside protected, whilst providing that attractive yield, as I mentioned, of 9% based on the 31st of March share price. I think on the next slide, I'm just summarizing some of the key points and highlights of our results that I mentioned we announced on Monday. The two real key ones to highlight, clearly, that NAV return of 9.2%. And I think, again, we think you should see that in the context of the strong downside protections. Again, the fact that we're not just equity, we're equity and debt, and the fact that we've got that high level of contracted cash flow, that risk-adjusted return to shareholders, we think is really strong. And we're really proud of the dividend cover, which is 1.1 times, 1.2 excluding exceptionals, and with more earnings to come as we build up that battery portfolio I spoke about. Our underlying portfolio grew in valuation over the course of the year, and that was driven primarily by expectations in power price increases and inflation. It was offset by increases in our discount rates that we apply to value our assets. Probably the one other point I'd call out on here is that Triple Point, the manager, has a lot of conviction in this investment strategy. We take actually 20% of our fees in shares to align our interests with our shareholders. And in addition to that, Triple Point has bought a little shy of 400,000 shares in the period and bought a few 100,000 more subsequently. So Triple Point's a real believer in the strategy and the opportunity that this is trying to take advantage of. And I think the last two slides, this is about our pipeline. I thought this was really interesting to show, and hopefully listeners and viewers will be interested in this as well, is to try to break down the sorts of returns that we're seeing in the market for different types of opportunity. We've got this really privileged position to sit across the whole of the energy transition, looking at debt and equity. Where are we seeing returns? And of course, we should all be seeing this, in the context of where the risk-free rate is. Again, distributed energy generation is just a classic example of where there were some really interesting years of returns, and then a wall of money sort of arrived and compressed returns, particularly in solar and onshore wind and offshore wind, to reduce the returns to a level that now, when you think about the risk-free rate, isn't that interesting anymore, I would suggest. And you're starting to see that, I think, in energy storage, where returns are starting to compress. Obviously, you've had a backdrop of higher equipment prices, lithium carbonate and so on, increasing, cooling off now a little bit, but still elevated compared to 18 months ago. High developer premiums, longer grid lead times, etc., and more capital. You've seen Brookfield and Masdar and others come into this space, and that's going to compress that equity yield, and that's why we quite like the debt piece, because no one else is really doing that. And then our long term, as you can see, 11% in our long term on-site area, and that is things like green hydrogen, electrification of transport that I've mentioned already. That's the really interesting piece, and that's why I look forward with confidence for TENT, because we've got the ability to drive higher returns in an environment of increasing base rates, and we're not just committed to a single technology where actually the return has compressed to very little, given its maturity. So that's the outlook for us. Obviously, some really interesting opportunities as we're able to grow. So I guess the final comment then is just, we're really proud of the level of contracted cash flows. We're proud of the results in the year just gone. That forecast earnings we think is, if not the highest, and certainly one of the highest in the investment trust market in our energy space. And what you get by investing across the transition is that really differentiated proposition of a really naturally diverse portfolio of different technologies and different niches. And going forward, our strategy is the same: is to really scan critically the energy transition, not just to go to where the significant sizable opportunities are, but to look for those niches and to find that really interesting risk-adjusted return. And I would say in an environment of higher base rates, that niche strategy that we've been adopting since we IPO'd is more important than ever before. So I hope that gives you a useful overview of what TENT is about, and obviously delighted to take questions or debate any aspect of the energy transition.